Ambareesh Baliga, Chief Operating Officer at Way2Wealth, is here in the studio. Shardul Kulkarni, Senior Technical Analyst at Angel Broking. Neeraj Dewan, Director at Quantum Securities, is with us as well. Gentlemen, good morning. Great having all of you with us here on the show. Ambareesh, so what are we looking at after, 300 points off the lows from the last time we chatted? I think we met around the time that the index was around 4,000, 4,600,
4,700 approximately.
Yeah.
And
Yeah.
at that point of time, I had clearly mentioned that I'm asking all my clients to just stay out for a while. Because all the way down up to 5,000 levels, we were picking up. And when it broke 5,000, I said it's time to stay out. But now with the sort of a bounce back which you have seen, I think the maximum upside which I see, as of now is about 51, 52. I don't think the markets really have the steam to go beyond that. Because whatever we saw was more of short covering than real investment buying at lower levels. There's not much of money still flowing into the markets. So since it's more of short covering, I would suggest that one should be at least booking profits to a certain extent, profits or losses, whatever it is, and get into cash to a certain extent, because overall I think broadly we should be moving in that range of 47 to 52, because a decent 4,700 level decisively when advice to traders or even investors as such will still be the same, that stay out. But given the opportunity which is thrown up right now, book out to a certain extent and get into cash.
Your retail base, so what do they want to do? Do they just want to act one way or the other?
No, I would say just not retail. I think market overall is confused. Even if you talk of those smart investors, those HNIs, everyone is confused because no one really seems to have made money in this market. And all through whichever levels you have bought, whichever levels you have thought were extremely attractive, you have made losses. So people right now just want to stay out. They don't want to look at equity at all. You take a debt instrument to them, you talk about gold, people are happy to talk about. But if you talk about equity, no one is interested. I think we are clearly in that sort of a situation where, this is an asset class which is really not anywhere on the scene as far as the investors are concerned.
Neeraj, you want to comment? We are catching up for a long time.
Yeah, good morning. Yeah, I think last about what we saw in November was really volatile market. You see too much volatility in the market. But I think now, we are getting into December. There are two important factors to watch. I think one would be what Eurozone is going to do about their debt concern. I think this is high time. The next about 7-8 days we'll get a clarity about whether they are going to have a solution which will be a little long lasting than the earlier solution they had suggested. And second would be our domestic interest rates. I think that also in the next couple of weeks there was indication earlier that RBI will pause this time around. But slowly, because seeing the inflation figures, seeing our GDP, we're getting a sense that some sort of action might come on the reverse side from RBI, whether it's a CRR, whether it's interest rate. It's a little early to say, but I think some sort of optimism is turning towards that side also. So I think next couple of weeks are very important for the market, and I think both these news will be very important for the market for the next 1 month.
We'll talk about that when we get there. If it turns out to be important or nothing, but what's your stance? Surely these things could act at the margin, but it wouldn't really swing things around, right? Dramatically. That we're talking about 2012 being a completely different year. I'm sure that won't happen because of whatever the RBI or what happens in the out of Europe towards the first part of in the first part of December. That meeting that you were talking about.
See, basically, last 4 months we've just been, talking about Europe. I think we're reacting to any news. Mostly it's been negative from Europe, and our markets have been, reacting each time there's been a fall. We've seen new lows in stocks. I think most of the things are already getting built into the prices. Now you need, if you get some clarity there, I think people will at least, even if we're able to leave Europe aside for some time, I think then you will at least get the valuations back in line with what the historic valuations are. We can't keep on trading on these kind of valuations, stock specific wise. Forget about the market in general, but if you see stock specific, valuations are drastically low. So I think we need to see some reversal in the sentiment. If you see, Europe getting out of the way for the time being, and some, reversal in, as far as our domestic interest rate scenario is concerned, I think then that will give a cue for the next year. I think that is what you want to watch, and even the indications which are coming. You've seen inflation coming down in the last 2 weeks. The kind of concerted effort done by the central bankers 2 days back, just 1 day back, that also was taken quite positively by the market. So market is now hungry for any sort of good news. Some good news coming our way, markets will react, and you can see, stock, some interest coming back. For good interest to come back will take a lot of time because people are really fed up the market. No one's making money, but at least some interest will start coming back into the market.
Ambareesh, you want to?
Yeah, I mean, the level to which we have come, I'm just not talking about the market, I'm just talking about the sentiment overall, whether it's internationally or domestically. But, I mean, what generally happens at these levels is the survival instinct comes out. And the survival instinct we have actually seen happening, where you had the Fed now working with the other central banks to pull up the economy overall, whether it's the Euro or the US economy. But then, unfortunately, in India, we are still not seeing the survival instinct. The survival instinct is there with our politicians at an individual level, but when it comes to the collective level, absolutely there is no survival instinct. So, I mean, we are all trying to pull each other down, and that's what is hurting us more than anything else. But from an investment angle, yes, I suppose this is a great opportunity for those who have money to invest, who are investing their own money, not borrowing, and are not really responsible for that money to anyone else except themselves. I mean, if you're investing today, you should not be looking at your investment at least for the next year or two. You should not be responsible or answerable to your investments to anyone. Then yes, I think this is a great time to go ahead and invest.
But Ambareesh, the move that the Fed and the other 5 central bankers made 2 days back, or 1.5 days back, you support that? I mean, that's a survival instinct. They were not trying to help the economy. They were trying to help financial institutions. It's basically overnight lending to financial institutions.
Absolutely, but at least they are doing something to improve the sentiment.
I'm trying to survive.
Trying to survive.
2008 was similar, Shakti.
Absolutely.
They were lending to financial
but again, at the
institutions
same, but at the,
yeah,
I mean,
so that's why we had a chart. That's why we had a chart. It didn't help the economy. It didn't help create jobs. It helped create Goldman Sachs stocks to go up. It helped JP Morgan stocks to go up.
No, I think Ambareesh was making a different point. Ambareesh was saying,
see, I'm not saying it's a long-term solution, but at least they are trying to do something. Here, what we are looking at is the government is proposing, the opposition is disposing.
No, I think what's happening in the parliament is a great, I mean, if you want to look at something,
it's a great worry for all of us, because today I think, whatever is happening at the domestic level is more of a worry than Eurozone and international issues.
But we voted them to power, right?
We, in a sense, I suppose it's more of the rural India which voted them to power than, I suppose, the urban India.
Shardul, good morning. Where do you stand? Expect Nifty, I can read your views here, expect Nifty to retest 4,700 and resistance at 5,000. I mean, come on, give us something more.
Yeah, let us take it by the day, what we are seeing is that every day some bit of news comes out, something which is unexpected. Frankly speaking, I was not expecting this particular upside, 50% retracement which has taken place. So I would say that, so long as it stays below 5,000, let us be bearish. If it crosses 5,000, one can take a call that yes, 5175, 5200 may be tested. On the lower side, if you break yesterday's low, then I think that you may test the levels of 4700.
Right. So on the panel, the only person who's thought that at 4600 the market will make a trading bottom and you'll get a move to about 52, 53 is Mr. Sarvendra Srivastava here, sitting next to me. Sarvendra, so what are the chances that Sarvendra is, and you, it's self-introspection. What are the chances you have been plain lucky, or, this actually is a move which people are still not ready to believe? So, you get more convinced every day, Sarvendra.
No, I believe in the Pareto's principle. So for everything there's an 80-20. So if you say luck, then you can put it at a 20%, but it's a more hard work than luck. Right. And that is how we've been trading the last 12 months. We've made almost and the views are on the NDTV archive if someone wants to check. More than 18 to 1900 points on the Nifty, right from 5700 levels itself. So yes.
My point was actually, but the second part was the more important part of the question. So when you see, I mean, people not ready to believe and still saying, I mean, it's time to sell, already time to sell, or 100 points more and it'll be time to sell. I mean, do you get, do you beliefs get strengthened more or?
Absolutely, absolutely, Prashant. As I said earlier also, you don't need to be a reckless contrarian, but at levels like these, when you are coming at the back of a 12-month decline and you are at crucial retracement levels on a long-term scale, and we have had so many stocks that we have discussed, Larsen, SBI, today we discussed BHEL, which are all at yearly supports now, yearly 61.8, or if you put slightly larger at a 38% retracement of the entire move from 2008 till 2011. So when you come to levels like these, and if you are getting those signatures, then yes, you can take it. I would have not taken a contrarian kind of a bet at say 5700 or 5500 because those were very shallow retracement. There was just 23% retracement. And as earlier I had shared that within two large cycles, I have not seen in India at least two large retracements. So if the first retracement, which was 2008, was a 61-70% retracement, the next retracement I think would be contained anywhere between 30 to 40%. And that is what is happening. 4700 is around the 38-40% mark of the same thing. So I'm just going with the base assumption that as I said, right from 2008, I've been believing that India has started a structural bull market which will last at least 12 to 13 years. And we are just doing a correction. So we are already past 4-5 years in that. So we did 2011, then we are doing now 2010, 11 top, and now we are to the fag end of 11. So I think 11, 12.
I have a quick question for you. You said a big reason for your belief system that we are at a significant bottom around that 4650, 4700 mark is that is the 38.2% retracement of the entire 08 to 010 move, right?
No, I said that India, at least if I go to Sensex, two subsequent retracements in a cycle have never been large. So if the earlier one was 61 or 70, the next one is 30-40, then again the next one comes at a 50-61, yeah, the next one comes at a 38-40.
38.
I think Shardul wants to come in. Shardul, you got a point?
You know, I tend to agree with what Sarvendra is saying. The only thing is that my retracements are coming a little lower. So my view comes in around 4400. Probably the levels at which we are taking the retracements are a little different. But basically I would say that yes, 4400 to 4700 is a good time to enter because 61.8 has been retraced earlier. So chances are that you know, the market takes supports near the 38% retracement. So yes, I would tend to agree with that. 4400 to 4700 is a good buying zone. Of course, you need to have a time frame wherein you're willing to wait for 2-3 years to make multi-bag gains. But the scenario seems quite right for a rally. You know, you're clearly seeing that if it goes to 4300, just imagine the scenario that the market goes to 43, 4400. You will see complete lack of interest. You will see there is no, no one participating. The FII flows dry up. Nothing works in favor, and suddenly you have one small positive news, and you will see that the market rallies, which is exactly what happened in October 2003, wherein the market was in a consolidation for a good long 5 years, and you had, if you leave the IT stocks, yes, 5 years. If you consider the IT stocks, then yes, 3 years. But 2003 October, wherein the market just rallied, wherein nobody could get in, and you saw that the market gave you a good 100% on the index in just 12 to 13 months. So similar scenario is expected to pan out, but I would say that let the market complete the retracements. I would expect this particular current leg probably to complete around 4400. But presently, the wave count which I am looking at is that there is one last wave which is left, and that wave I would consider which will take us to those 4400, 4500 levels. But I do agree that yes, it is a brilliant time to invest in the markets if you have a 3 to 5 year perspective.
It seems there is a hidden bull in all of us. That's the way to put it.
And people think that Shardul is a very
there is a hidden Ambareesh, bullish Ambareesh behind the.
No, I mean absolutely. See, I'll just tell you. I mean, if you look at the fundamentals, standalone fundamentals, forget what's happening. I mean, all around you right now, because what we see happening all around us could be temporary, and there's a hope in all of us. I mean, life is full of hopes. End of the day. So I mean, if you're investing at this point of time, the chances of you going wrong in the longer term is minimal. That's one of the reasons I've been saying that if you're investing now, you should not be looking back at your investment at least for a while. And at the same time, no one should be questioning you about your investment, because I mean, as a fund manager, as an advisor, end of the day, we are all human beings. You have 100 people coming and banging you every day saying that you told me this and it's down 20%, it's down 40%. I mean, it plays on your psychology. So that's one of the reasons why, from an advisor's angle or a fund manager's angle, I think it's one of the most difficult times for them. But if you're an investor using your own money, not responsible to anyone, I think it's a great time to invest. Because I really don't know as to how much more cheaper you'll get from here. If you get it 20-30%
So
cheaper,
instead of saying book out profits at 5,000, why not tell? Ramdev Agarwal was on the show a couple of days back. He loves Central Bank of India. We've spoken about the stock for the last 3 years when the stock was at 50. So the stock is at 90 right now. The high was 175. He's got a lot of Central Bank of India disclosure. He says you should buy. I mean, it's a great bank. 90 rupees. It's a great bank. You should definitely buy. The stock can correct 50-60%. I mean, that's on record. I can't guarantee it will not correct 50-60%, but I would be a buyer of Central Bank of India at 90. I mean, where it is right now, because I don't know. I think it's a great bank. It will do well. But I mean, why not say that?
Possibly. Yes, but tell me how many people can take their 50-60% loss from the current levels?
So, but leave it to people to take that trade or take that.
With that sort of a disclosure is perfectly fine, but I suppose 98-99% of your viewers are looking at short-term gains. I haven't seen people who have a view of more than 1 or 2 years. There are very few people who have that sort of a view or the patience to wait for that long.
But Ambareesh, even if I am a long-term investor, serious long-term buy and forget for the next 6-year kind of an investor looking to catch a big cycle on the index, have we reached 2003, 2001, 2008, those kind of entry points, those kind of attractive valuations? I mean, we had this thing Pankaj did 2 days back. Nothing. I mean, some of these stocks are 50% above those levels, 60% above those levels. They need to correct 50-60% more to reach those kind of attractive, juicy levels.
Yeah, but some of the stocks, but most of the stocks have come down to those levels.
Largely large cap.
Shakti, I'll want to come on that. See, you are just comparing plain numbers. When we are saying that market's in a constant progress, right? And I'm saying that a wave 2 will never retrace more than 60% of a wave 1. Assuming that's the case, then that 61% can lie anywhere. Right now it's somewhere around 3,800 levels. You will not get a new low on many stocks, and the stocks will continue to take, they will reverse from 50-40% higher from those levels. A 61% retracement.
I was talking from a valuation perspective.
No, what I'm trying to talk from a valuation perspective. But you are giving numbers, no, that stocks are still trading 50% above.
Valuation perspective also.
Above those valuation levels, above those price to earning levels, above those price to book value multiples.
Wave 2 will never retrace.
I don't know about waves. I just know about C waves.
Valuation perspective.
I just know those waves.
So that is what I'm trying to tell you. In a bull market, even if you look at plain Dow theory, what he says is that in a bull market,
I thought you were not a proponent of the Dow theory.
No, I'm not. I'm saying he also says about retracements. Whenever you are taking a retracement in a bull market, you assume that the previous low will not be broken and you will retrace 60-40% and you start going up. So every time you will not get those valuations because you are in a cyclical degree move that is headed higher, right? So you will not get those valuations.
Okay. Neeraj, I mean, so since we've extended the time horizon from RBI next month or Eurozone, where do you stand? I mean, 3 years, 4 years. I mean, how do you think about prices right now with those kind of time frames in mind?
I think if you are thinking of inflation level of about 7.5 by March, I think keeping that in mind, I think we should at least trade about 15 times. So based on that, also these levels are quite important and quite interesting, stock specific. You have even the large caps, if you see, they are right now at very good valuation. So I think current levels are also, you can have a 5-10% down move, because of any bad news in the short term or in the in the next couple of months. But I think even at the current levels, if you're investing for keeping 12 to 18 months in mind, I think you can get a decent return even from these levels. Forget about mid caps, even large caps would have a decent return from these levels.
Okay. We've got prices in the pre-open session on your screen. We're about 5 minutes into the pre-open session. 9:08 is when we get firm prices. 9:15 we go into the normal market. session. 21 points higher on the Nifty, 49.57, and 16,479 on the Sensex, which is off about, which is up about 4.5 points, a third of a percent basically. So stocks on the screen. Let's get to a couple of more stocks. Shakti's got those names. Barmer Lorry, a few all time frames, weekly, monthlies. Dailies.
Yeah, I mean a lot of stocks in many time frames. So actually I have too many stocks, so I'm just waiting for the order. First, the Barmer Lorry monthly chart. Again, a similar kind of a long-term monthly time frame. Big major low back in June 2004, joined that with the December 2008 low. We had support around 480 last month when the market had this big bottom. It took support exactly at that 480 mark, then has pulled back substantially from those levels. So 480 becomes a big support for the stock. Not a very liquid stock, very actively traded stock, but a favorite of many investors, long-term investors. The trouble is there are quite a few tops around about 200-300 points above that 500 mark. So over the last 5-6 years, it has made multiple tops around that. Difficult to see that getting violated, but if 480 holds, you can get a decent bounce from here on. Below 480, it looks really shaky. The next one.
Sarvendra is shaking his head here. But we're not talking about waves. You have a problem with
yeah, no C waves.
No, but I don't know.
Or no super cycle. No cycles or waves.
I have not met any HNI till now who has got Barmer lorries in portfolio. So I don't know how much Barmer lorry.
Okay, that's a different point. That's a different point. Go on. So Barmer lorry.
I forgot. Okay,
Hero
the next
Motor
one is Hero MotoCorp. Again, a weekly chart from the February lows of 1400 odds. For the Nifty, it was 5177. We are below that, substantially below that. This is almost 50% higher from there. The trouble is, it made a lifetime high just 3 weeks back, but it's starting to top out around there. One of the strongest stock. It's almost like an Infosys. What kind of return Infosys has given over the last 20 years. So 2000, a big support. If it holds on to 2000, probably can rally up to make a new high. Definitely never short Hero MotoCorp. I mean, it's probably the strongest stock in the market. The next stock I want to talk about is Jain Irrigation. Same 61.8% theory. No waves over here. I just took the bear market low, December 2008, 45.4. Lifetime high, August 2010, 264.4. 61.8% of that, 129.05. Broke it in October, big cut in November. December has just started, so big resistance, just 9 points, 10 points away from these levels. That's one very good risk reward entry point for that stock. JSW Steel, spoken about it enough times. Bear market low 160.1, bull market high, lifetime high 1400, 61.8% of that, 633.75. We are right there. We had a close below that, then a pull back, then a close again below that in November. So the whipsaw has happened. Now if it breaks below this, that will be a big break. And if it pulls back substantially above it, probably the worst is over for this stock. But this level becomes a big one for this stock. Orchid Chemical, as clean as it gets. The May high, join the July high on a weekly time frame, get about 174. Again, almost very tradable. We are right there. Above that, it's a buy on a weekly closing basis. Below that, it continues to be a sell. Two other names, two other charts I want to talk about are Sterlite Industries daily chart. Now again, we saw this chart yesterday around 3 o'clock. Day before yesterday, it had closed at a 30-month low. So almost back to the bear market levels. October high here on a daily time frame. Join the lower top and you get about 104 yesterday. Shot up big time, but then cooled off. Held on to that 104 mark, respected resistance at the 20 DMA 110.7. So between 104 and 110.7, it will be a decider for this stock. And I think I have got one more stock, and that's. Do I have one more? Okay, that's it, Prashant.
Sterlite Industries. I want to touch upon Hero MotoCorp. We've spoken about this in the past as well. Neeraj, so I mean, you know, you look at charts, and generally the rule is don't sell strength. I mean, especially in a market like this where there are very few pockets of strength. But do you have any thoughts about Hero MotoCorp? Why should Hero MotoCorp trade at some 21, 22 times? I mean, it's a two-wheeler company. The Japanese are out, which basically means that they've got to develop their own technology now. And in a way,
I have a sense.
Yeah, go on.
No, I have a sense that at the current levels, Hero MotoCorp also doesn't look attractive now. It's been trading at such high valuations for a very long time, because you see last 1 year at least there was some performance. we've seen that, last 2 years almost now, we've seen some performance, month on month. So I think now at the current levels, I would rather shift to stocks like Maruti, where you've seen a correction, you've seen, all the bad news being priced into the stock, and they've made a base at these levels, and valuation was also looking attractive. So if I would be invested in Hero Motors, I think this would be a good time to, exit partly at least and shift to a stock like Maruti.
Okay, sell Hero Motocorp, you'd be a buyer of Maruti right now. Any other ideas apart from away from large caps, Neeraj, which have gotten to levels where you can't, do anything but try and buy some?
Yeah, basically, even if you see active mid-cap stocks, a stock like Gen Irrigation was just mentioned. Just showed the chart of Gen Irrigation.
Right.
A stock like United Phosphorus, they will have some sort of problem because of foreign exchange, because some immediate short-term concerns are there in the stock. But I think over a medium to long term, these are becoming very attractive. So even for a research, we are looking at these stocks, and they are into a buy category and even invested by our clients. So there will be disclosure to that extent. So there will be stock like IRB Infrastructure. So there are actually active mid-cap stocks which are coming at very attractive valuation. So I think these kind of stocks can also be looked at. They can give you, very good returns over 1 year. If your large cap can give you 20-30% return, they can give you much better return than that.
Did you say United Phosphorus? I caught Gen Irrigation and IRB. You said United Phosphorus as well?
Yeah, I said these three stocks:
Right.
United Phosphorus, Gen Irrigation, IRB Infrastructure.
Okay, all right. Got it. Neeraj, thanks very much for your time. Great having you with us here on the show. Appreciate it. Vineet Bhatnagar, Managing Director at AMF Global, is joining in right now. Vineet, good morning. Great to have you with us here on the show. Prashant this side. We were just talking about here on the show, with a long enough timeline, are we at valuations or price levels where, you should try and ignore the very near term known negatives?
Yes, I still do not think that, whatever we have seen in the last 30 days, which has been quite a yo-yo, Nifty moving to 5400, then rapidly collapsing to 4600, and the stupendous gap up session that we had yesterday, however, still being faced with the resistance of 5000, 5020, it still does not, to my mind, change the fundamental uncertainty in the minds of people, which come from various sides, whether it be relating to the local macro, whether it be relating to the liquidity related concerns in the global market, or the much talked about, often repeated uncertainty arising out of Europe. So I don't think the dark clouds are clear yet, and I think it will be too premature to say that the relief rally that one saw from 4600 to 5000 in the last few trading sessions is an indication of all being well now.
No, not all being well. So essentially, if you're ready to, if you've got the appetite to see the market going back to 46, breaking 46, etc., you can never time those things, and you'd always be premature, because the other option is basically being left 30-40% behind, and then you get on the bandwagon. And we have long enough time frames that we're talking about. 3 years.
Oh, yes.
3 years kind of time frame, right? So with that in mind,
oh, yes.
Yeah.
Yes, I agree with you. If one has a time horizon which is based on a portfolio construction, and on the basis of that one is doing stock level selection, that some of these stocks that are available are such that it is indeed timely to start accumulating them. I completely agree with you that very few, or perhaps nobody, is able to time the bottom of the market. So whether the bottom comes at 4600 or a few hundred points below that is not necessarily the point. As long as people understand that there is value
Right.
that they can identify in stocks.
Right. Vineet, so, are you advising people with those kind of time frames in mind right now? What's the message going down the organization at MF Global? Or try and pick a bottom, pick a trading bottom, that kind of thing.
I mean, you always have both kind of clients. You have clients who want to understand as to what could be the trading strategy that they would that we are recommending on a given day. So there is always that pressure to give an analysis which is which is satisfactory for a short term. However, those who have the appetite, and especially the high net worth individuals who are interested in wealth creation and portfolio construction, for a while now we have been advising them that they have to start looking at accumulating stocks with a 3-year horizon, and that's the way the life will be. So today we have to give bear spread strategy on Nifty, because that is what we started with as a strategy for yesterday, and that's a strategy which is open this morning as well.
Vinit, good morning. Shakti here joining in. I just had a question about the building of the portfolio, kind of a thing that if you buy good blue chip stocks with a 4-5 year horizon, you will make money. I mean, I have nothing against that theory. Probably it will make sense. It will probably make a lot of money. But don't you think similar theories were being sold to the market or investing public back in 2007, say 4 years back, mid 2007, late 2007, that with a 5-year horizon, even if the markets are in a bubble or even if they are above their intrinsic value, whatever valuation matrix, that in 5 years time you will make money. 4 years down the line, 4.5 years down the line, you are actually losing money. So my question is simple. I'm not questioning your theory. I'm just questioning that how much possibility would you give that even investing right now with a 4-year horizon, you might actually be losing money building a good enough portfolio 4 years down the line?
No, it depends upon what time of the cycle that you are in. 2007 or end of 2006 was a raging bull run. Right? If that point in time, the advice that was coming out was that keep buying, the party is going to go on forever. That is one way to look at it. The present context that we are looking at is perhaps more comparable to the 2003's situation. So if you have to really pick a comparative assessment, then it cannot be 2007, because that is a different point of the sentiment on the street, and also the euphoria in the local market. At this point in time, I guess the tone that one needs to adopt is of the nature where this should not be touted as a bottom. This should definitely not be touted as the screaming valuation related buying opportunity, because we all understand and must be cognizant of the fact that there is some room that is visible on the downside, whether it comes from the local macro or elsewhere globally, and therefore it will be only misleading to say that what you buy today, this is the price that you will not see again. So prices will go down, and clients need to understand it, and the brokers need to highlight this to their investors.
Okay, Vinit, on that note, I have a second question. We had this big debate over here a few days back that has the typical Warren Buffett kind of a buy and hold for the next 10 years, good stocks and you will be a millionaire thing, been overfed to the investing public? And do you think ultimately as markets mature, they ultimately become trading markets? Those raging bull markets where the index goes up 6 times, 7 times, those days are over. Ultimately you can get even a 20, 30, 40, 50% bounce, but those bull markets are over. 2003 will never come, those kind of valuations will never come. So maybe if you want to participate in the market, you have to become a trader, not an intraday, not a weekly or a daily or a monthly trader, but look at the market from a trading angle and not just buy and hold.
I mean, these are two sides of the coin, if you ask me, and I'm not trying to be diplomatic here. But the point remains that will people make money if they have an understanding of the valuation and do a judicious stock selection and have an investment horizon of 4 to 5 years? I would still say yes. I think that style of investment is not going to go away in a hurry. Clearly, the point that you are making is embedded in the current volatility that we see across all markets globally, which of course includes India too, and therefore there is a temptation to start looking at time horizons in smaller slices And from that perspective, there may be a case to be made where a portion of your investable amount should be dedicated to a 3-month trading strategy, a year trading strategy, 3 weeks trading strategy. You could decide as to how you want to look at it. Will you make money in that? Perhaps the number of hits and misses are going to be more in that kind of a perspective. And we do have clients who are long-term investors, but also have a portion of their investable amount dedicated to a trading style.
Your question was more philosophical. Is buy and dead, buy and hold dead, basically?
Buy and dead. I never said buy and dead.
Buy and hold dead.
Yeah.
That was the point.
But he is a philosopher.
Philosophy.
Yeah.
You know, I've got a chart here. Every time I try to put up, I never get to do it, but I'll do it now. This is Prashant Jain at HDFC Mutual Fund. I've spoken about this in the past as well. He put out a note in August 2000, this year basically, August 2011, and he compared at various time horizons. Now, obviously, it's a matter of which point in history you pick and say, this was the P, this was the return if you, this would have been the return 3 years later, 5 years later. September 2001, this was terrorist attacks in Twin Towers in US. The Sensex forward P was 11 times. This is the point we were making. Absolute price to earnings. We're not probably there even in terms of price to earnings, but are we close? September 2011, Sensex level was 2800. The P was 11%. 3 years later, the return is 84%. 5 years later, the return was about 316%. June 2004, general elections. The Sensex level was 4795. 10 times 1 year forward PE. Return 3 years later was 203%. June 2006, 9296 Sensex level. Forward PE was 13 times. This is collapse of the US housing market. 3 years hence, return was 61%. November 2008, subprime crisis, Lehman collapse. We got to 9093. 1 year forward PE was 11 times. 3 years hence, return was 100%. Right now, we're what, 14 times, Ambareesh?
Approximately.
14
Less than
times.
that. Less than that, in fact. 13 and a half, yeah.
13 and a half, 14 odd times. So maybe we're not there yet. Maybe 10%, 20% more. Just looking at, and this is just the Sensex price to earnings multiple. I mean, so we're not getting into stocks and this is not cheap, that is not cheap. Just consolidated index. What is the price to earnings?
No, but then again, I mean, you get those situations once in a blue moon. Again, how many of us have that patience to wait for that particular time? You don't know whether it'll happen or not. I mean, all of us are trying to play in between. I mean, you're
talking. Why?
I mean, you really can't wait for those specific bottoms and tops to buy and sell.
No, that's not my point.
I think it's foolish to do that.
I think my point was, so this basically, this simple piece of analysis, I'm assuming this is correct, tells you that, I mean, without doing fancy research, etc., if you get a price to earnings multiple, this is going back the last 10 years, you get to about 10 times, 11 times index.
You can't do research in a market like this. I mean, whatever.
Why not, Ambareesh? Come on. We have evidence that at this price earnings,
I think now we had all the time to do the research.
I'm talking of fundamental research. Even 3 months back, a stock which was looking fundamentally very attractive is today much more attractive.
No, but what's wrong with that? That's fine.
So basically,
that's interesting, right?
One needs to do a fundamental research, no doubt, but today it is more of sentiment and psychology which is playing on the markets. So you need to understand as to where the markets are in terms of investor psychology.
Ambareesh, that's not the point. The point is, I mean, nothing is new, as they say in the market, right? I mean, all of this has happened before.
Yeah.
Right? So, I mean, you've had market situations where at that point in time you would have attributed to investor psychology and this and that and everything else. But the point is, this is where we are. You look at prices and we're just doing hard numbers, looking at hard numbers. Everything else is secondary, right? And everything shows in the price, assuming everything shows in the price. Right. So, basically we're saying is, I mean, you look at the index multiple and you say, not trying to time, I'm not saying try to time, with a 3-year perspective, that was what we were talking about.
That's exactly what we were saying earlier, that this is a great time for those who don't mind waiting for.
So we agree.
We agree on that, but then again that depends.
Prashant, the buying has to start in a decent kind of a range which is near to that.
Absolutely.
You can't press the button at 11, right?
No. The reason I spoke about this is because, I mean...
No, slightly contrarian way of looking at this data is that we got into those kind of valuation multiples because of a 9/11, because of a government, I mean, NDA government losing elections,
right.
Because of the left coming out and saying, share bazaar bhaad mein jaye, because of a big crack in 2006, commodity prices got hammered 67%. 70% in a matter of 2
Now
weeks.
again we're looking
and
at
Lehman Brothers.
Now again we're looking at now we're again looking at subjective stuff.
It's not a
we're again looking at subjective stuff.
No, Prashant, I've not finished. So my point is, here we are close to those kind of valuations without a Lehman, without a 9/11, without a NDA losing elections, which means that probably there's something really wrong this time. I mean, so something really big ensured that you got those valuation price points. Now, without anything big happening, you are getting
I
there.
don't want to look at NDA and left and this and that. I'm looking at numbers, right? Just go with numbers.
So are we there?
Just no, we're not there.
Shakti
Probably
knows something
10, 15,
that we don't. Shakti knows
10-15% more and
that probably, and
10-15% more, essentially.
Yeah, but
Looking at these numbers, but if
15%
you
on the
say
index, 15% on the index.
I mean, yeah, going by price to earnings multiples.
But the
yeah,
thing is, I mean, just assuming at 4650, 4700, there is huge panic at those levels. Say for example, the market goes down from 4950 to 4650 in just about 2 days' time, and there is panic. I mean, going by theory, yes, I think that's a great day to buy. I think people should buy on that day. But then those who buy on that day, just imagine what will happen to them if the market goes down to 4100. Can you buy more?
What will happen to them?
No.
What will happen to them?
The thing is that at 4100, will you give up and sell off? If that is going to be your mental makeup, then don't buy. But if you have enough money, if you have confidence in the stocks you're buying, if you're bought at 4650, you'll buy more at 4100 levels. You're sure of that, then go ahead and buy at 4650.
No, I mean, this is obviously this is directed towards people, and we are thinking that they have some framework of putting money into the market,
we should not think that way, because most of the people I come across, any major fall, they just run away. They don't even want to look at the markets. I mean, especially when it's the best time to invest, you will see most of the investors not being there. Like I said, 98% of those regular investors are today not there in the market. Whereas this is the best time to do your SIPs. Whenever you see a major fall, pick up a bit. But again, it is the psychology which is playing out today. I mean, the sentiment, like the sentiment which you're talking of is collective psychology.
Okay, so I mean, these are the numbers that we got to. Vineet, so I mean, history tells us that, I mean, whenever you get to whatever these price to multiples are, 10, 11, 12 times, you buy and you make money. And what's the best way to participate then? I mean, we keep hearing that consumer story is still strong. I mean, it has been strong. Most FMCG companies have done well and all of that. Is that going to change?
Actually,
Is that going to change? I mean, if you think about it, over the last couple of years, everybody, large global MNC players, have entered the market. More are coming in, right? I mean, do you have to change the way you participate? So instead of an HUL, you buy something like a Nestle. Basically, focus on MNCs rather than local players.
No, it's not a question of focusing on an MNC or a local player. I think it's a question of identifying stocks which have got a strong moat. And it is the strong moat of the company that makes Nestle or a Colgate or an HUL a buy even when the markets are shaky. Companies or business models which have got the strong moat are the ones that people pick up when the markets are uncertain, and that's why you come up with a name like Nestle. It is equally possible that an Indian company, whether in the auto sector, could be the one, or in heavy engineering is the one with a strong moat. So the logic that one is putting out is not an MNC versus a domestic company.
I was just taking that as an example. I was just taking that as an example. I mean, in terms of what has changed on the ground over the last 10 years, what has changed is MNCs are attacking that aspirational demand, which should rise, and which has risen over the last 10 years. So it probably has negative implications for consumer companies, local consumer companies over a period of time. That's where I was coming from. But what's the best way to participate?
I mean, for that.
No, so forget about FMCG. What's the best way, according to you, to participate if the index gets to whatever, 11 times, 12 times? Buy an index fund, try and pick stocks. What's the best way to participate?
I think it is very difficult to make one statement which is applicable to all. I think the point that was being made just now is that we need to be in a position to distinguish who are we talking about. Are we talking about a professional trader, a person with a sufficient amount of gut and conviction to go out and start picking when the index is at 4100, or we are talking about the man on the a common man on the street? If we are talking about a common man on the street, clearly when there is panic on the street, he is nowhere around. And therefore, if we all believe
Vinit, why is there this big difference in treating one set different from others? At the end of the day, money is money. People lose money. When institutions lose money, they lose money. When retail loses money, they lose money.
No. Money may be money may be money, but it is the sentiment, the psychology, and the how deep the wallets are that makes the difference. The way I behave to a market price is different from how a professional trader will behave to a market price.
I get that point. But we are talking about, the context is you're basically getting to an extreme price point, which is then the same for everybody, right? We're talking about
yes. And will the reaction of everybody be the same? Are you expecting and estimating that at that extreme price point, everybody on the street is expected to behave same? Whether it's an institutional investor or a professional trader or smart money or a common man. And therefore, the point that was made earlier, just a little while earlier, when one understands that hereafter there is a range where the market will actually move to an extreme price point, a retail investor, a common man should participate in a more systematic manner through an SIP. Whereas somebody who is
in a way, Ambareesh, aren't you doing a big disfavor? If you think this is a great time to buy, and you said this is a great time to buy, if you're not answerable, to anybody with the capital that you're putting in it, aren't you doing a disfavor by telling retail, don't go in, don't buy?
Because
we're not talking about some satta and futures and options. We're talking about buying stocks to hold, right? So what's going to happen? If you seriously think that this is a great time to buy, right? So aren't you doing a disfavor by keeping them outside of?
We are not keeping them outside. We are telling them possibly it's a great time to buy with that sort of a disclaimer. But when you're talking on the media, it's a one-way communication. So you really can't generalize and say that this is a great time to buy. In that case, whoever is going to follow your advice, and he's not prepared to shell out more funds at a future date on a further crash. Possibly he's buying with borrowed money. So in that case, in case he loses,
I think our discussion made it pretty clear that we are not talking
Prashant,
about
a very valid point that Ambareesh has made here is that if you follow someone, and if you follow someone, you believe that he is good, right? So we are taking that base assumption that if you are following someone and you think that he is good, you have to follow him to the T. Then you can't apply your brain in between, right? So it's not you are TV or you're following someone on a printed medium. With him, then you will never be able to mirror the kind of NAV that person is making. And if you are believing in his NAV and you are thinking that his NAV is good, so you can never mirror the NAV graph that he is doing. So you have to follow to the T if you are following someone, or if you don't follow and then you do your own homework and you do it, no problem.
Prashant, the issue is,
that's a very valid point.
We are handling clients day in and day out. We've been doing it for the last so many years. But then what happens is a person who comes today and tells you, yes, I'm a long-term investor, I don't mind investing X amount for the next 3 years and forget about it. You prepare a portfolio for him, you invest today, the market comes down say 15-20%, although he's been told that yes, that's your downside. At 15-20% downside, he starts panicking because his mental framework may be very much different than what yours is, because at least I have seen the markets for the last 25 years. Surely I know that this is a great time to buy, but my mental framework need not be the same as that of the investor. And at that point of time, what happens is
I get it. I get the thing.
Ambareesh, just a quick one. In that case, do you blame the brokerage community, not one brokerage, this brokerage or that brokerage, that the way they have molded the retail investor has been wrong? They have been taught wrong things, because ultimately they are asked stop loss, buy, sell, trigger, 5 point, 2 point. Now that's for a professional guy who is ready to lose money.
To a certain extent, yes. To a certain extent, yes. Because the way the brokerage rates are, if you are paying 1 paisa, 2 paisa, whatever it is, it is the lowest in the last so many years. and finally,
Yeah.
if someone has to survive, that's where again the survival instinct of the brokerage house comes out.
So the broker Ambareesh
Alright, I
Baliga
got
is
it, I
saying
got
he
it. No,
stay
no, I
out,
got
but
it.
the investors, Ambareesh Baliga is saying it's a great time to buy.
Yes, but as a broker, I think it's harakiri for me to ask people to stay out. More the people trade, it is more money for me. But still, I won't like to I would like these investors or traders to take that risk. If their mental framework is not as a long-term investor, I wouldn't like them to take a risk and enter right now.
All right. I mean, interesting chat. We could have continued with it. A lot more to talk about, but running out of time here. Ambareesh, thanks very much for your time. Good to have you. Sarvendra, thanks very much. Shakti, thanks as always. Vineet, thanks very much indeed. Hope to see more of you here on the show. Thanks indeed.